Hello and welcome back to FICO World 25. We're here in Hollywood, Florida, really digging into the intelligence revolution and really understanding everything about FICO and their partners and their customers and really how it's being utilized out there in the wild. I think one of the things you probably can't come to FICO World and not talk about is FICO scores. I don't know that I could have two better people, there probably aren't two better people. I'm just going to say it right like that, to help me really break this down and kind of understand this and really go a little bit deeper. We have Julie May, who is the VP and GM of B2B Scores for FICO. Welcome on board.
Thanks for having me.
And we have Ethan Dornhelm, who's the VP of Scores Analytics for FICO. Welcome on board.
Thank you.
So, Ethan, I asked this kind of in a different way to one of the other contestants was up here earlier in the day, and I think that everybody kind of draws a line at the pandemic and says, okay, things rapidly changed after the pandemic, things especially in the world of data and information. What has really been the trajectory of risk since the pandemic?
Yeah, it's a great question. Thanks, Rob. I would say one of the ways we like to look at consumer credit risk trajectory is with the average national FICO score. It makes sense to use that as a metric because it is the common language of credit risk in the US. 90% of top lenders use it. And what we saw through the pandemic, the first year of the pandemic, we actually saw a significant uptick in the average score, significant, and that was driven, we think, by lender payment accommodations that were being offered at the time, government stimulus payments. This all allowed consumers to save at unprecedented rates, pay down debt, really help their balance sheets, and in turn help their FICO score. What we've seen since is really what I would call a treading water. We've really been stable with the aggregate FICO score in the 4 years since that real uptick in the first year of the pandemic.
Wow, that's good to hear. I think, again, I think that is a good way to look at it as well. And I think that when you're looking across all of the credit landscape, what are some of the trends that you're watching for from that perspective?
Well, I think, as I said, we've been stable for the last 4 years in terms of the national FICO score. The real question that's out there right now is, are we at some sort of inflection point? I don't think you would find anyone who would argue that the risk factors are out there higher than ever for a recession. There's this persistent inflation that consumers are facing. Some of the last supports that were put in place around the pandemic for consumers are being rolled back. I think all of that leads to this big question of what's next. And in that vein, one of the topics that's really hot right now is student loan delinquencies. So you're probably aware during the pandemic, there was a pause placed on all consumers who had federally backed student loans to have to pay those loans back. And only recently, those consumers who aren't paying, it's being reported in their credit file and starting to impact the score. Yeah. In fact, early this year, we saw the score drop in February, the average national FICO score, and that was the month that 4 million consumers had their student loan delinquencies reported for the first time.
I was going to say, I know I'm not delinquent on mine, but on my kids, that is. But I got the letter and all of that, and you had to log in and do all of the things and make sure everything was set up. But I think you brought up a good point, and I kind of want to bring Julie in on this because I think, to me, the lenders were doing stuff during the pandemic that they since ended and stuff like that. But to me, the FICO scores give them kind of insights into what's going on. What's really top of mind with those lenders and in the area in particular of credit risk?
Yeah, I think at the end of the day, lenders are always looking for more information to make better decisions so that they can provide credit to their customers and that they can expand their business while actually helping people, right? And so what we're finding top of mind is what data can they use and how can they use our scores, or what scores can they use to actually help them expand credit access. And so particularly, we're finding that our customers are interested in hearing about our latest and greatest score, FICO 10T, the T in FICO 10T stands for trended data. And so what this enables our customers, the lenders, to do is to actually understand across time how people's balances are changing, if they're consolidating debt. And the type of impact that can have to them is it can actually increase origination volume for lenders while holding credit risk steady. So we're getting a lot of questions about this. There's a lot of interest in using this additional trended data in credit risk assessment.
So that would seem like, again, to your point about having more information to go and act upon and come up with, that can help them maybe go a little bit deeper,
right.
or have, and I love the segmentation of one that was part right. of the keynote. Is that really where this 10T score goes and helps people with that?
Right, I mean, exactly. The FICO score is unique to every individual, right?
Yeah.
In terms of the algorithm is an algorithm, but it looks at every individual separately, associated with making an assessment of their ability and willingness to pay back debt, and makes that assessment based on data that we receive and to calculate the score from the credit bureaus. And so the more data you have in that process, the more precise that you can get in the assessment of risk. And so, we see lenders are incredibly excited about this. Particularly, we're seeing significant uptake and interest, and I can't walk through the hallway here at FICO World without having someone stop me and ask me questions about it. But particularly, we're seeing tremendous interest in the mortgage lending space, and so we've had incredible adoption in mortgage by the non-conforming mortgage lenders of 10T. We have approximately 30 lenders who are already using it. Over $300 billion in originations are being scored with 10T, and $1.5 trillion of servicing volume is being scored and reviewed by 10T. And so when people out there hear about others using it, they want to get on board and they want to hear about, how can they use it, what can they do, how can they implement this in their process. So there's quite a buzz out there about it.
Yeah, I think it makes sense. I think, again, this is one of the wonderful things about AI is it allows you to manage all the data, and those models are behind the scores really, again, that makes it easy for these lenders to have that information and things. But what are some of the approaches that you've seen that are helping lenders make smarter, more nuanced decisions like 10T, and where do you think that's really shaping, or how customer behavior is really shifting, is really making them reach out and look for these types of things? I'll start with Ethan.
Sure, I would start by saying when it comes to credit risk, the rule of thumb I've always followed is the more things change, the more they stay the same. We built our first FICO score over 35 years ago, and when we built that, we found consumers who had higher debt levels, consumers who were showing signs of missed payments, consumers who were applying for a large amount of new credit. Those were the folks who may be headed for trouble. Guess what, 35 years later, it's still by and large those same key drivers. So I take some comfort from the fact that while the products that are out there are certainly changing a great deal, when it comes to predicting credit risk behaviors off of credit bureau data, those overarching patterns that held 35 years ago still hold today.
What I would say is, I think the things that maybe have changed a little bit in the last 35 years, right? I don't know if I was around 35 years ago, but I kid. I think the things that have changed are consumers are more aware now, right? We have a lot of tools and capabilities available for the consumer to understand how important their credit score is, to understand what their credit score is, right? One example of that would be anyone can go out to myfico.com and get their credit score, their FICO credit score, for free, and the awareness and understanding and knowing what it is and why it is that, and kind of the building blocks of credit really help enable consumers to better manage their credit, right? And so I think that's changed in 35 years because those tools were not available previously. And so, we see tremendous adoption of those tools. We see consumers coming in, really being educated on what their FICO score is, and that only helps the consumer, but also the lender as well.
Yeah. Sorry.
I was just going to build. Julie's got a great point. There are definitely things that have changed. Maybe less so what drives credit risk
Right.
behavior, but the availability of data has certainly changed. We've seen the rise of alternative data, something that at FICO we've been innovating around for well over a decade now. We've got the Ultra FICO score, which leverages consumer contributed cash flow data. 35 years ago, there was no such concept of the internet, let alone the idea that a consumer could give their bank account credentials, offer up their DDA cash flow data, and in so doing, improve their FICO score, which 7 out of 10 consumers we found do with Ultra FICO.
Yeah, I've actually seen that and contributed to that, so you're glad to hear that product is doing well. So.
Right. 35 years ago, you'd been mailing your paper bank statement
Yeah.
into FICO. I don't think that would have worked.
Yeah, no, I mean the whole API economy and how things can, the data, and I think it seems like that consumers want to know as well, more so. Are you seeing that the lenders are, like, they're going and giving that data? Because I know my different financial institutions provide me my FICO score, once a month and things like that. Are you seeing that that's also helping that consumer behavior as well, where there's more awareness of it from that perspective?
Right, I think the tagline is the more you know, right?
Yeah.
Like my mother always used to say, when you know better, you do better. And I think that's actually true in credit too, right? When you know better and you understand what contributes to your score, you can do better, you can build a good credit profile, you can understand what impacts it. And so, I think her advice is good for all the people who are wanting to access and build their credit profile today. So yes, I think that's true. We have lots of different programs through lenders to make the scores available through their online channels and other different ways that they make it available. Then we also make it available through myfico.com. There are so many different channels now that consumers can get access to their FICO score and educational information on how to drive, improve, maintain their FICO score, that I think that's really evolved over the last couple of decades, and it's really exciting. We have a much more informed consumer than we used to.
Yes. And Julie quoted her mom, I'll quote my grandma, who said, knowledge is power. And I think we really have found that an educated consumer is an empowered consumer when it comes to knowing their FICO score and how they can improve it.
I would agree. I think to me, it's definitely one of those things that in information and the information sharing, but one of the things, and this is right up your alley, Ethan, is that the fact that the increasing role of AI in data analytics and the amount of data and the difference of the data, and like you were saying, it's not all the same data and more and broader. How is all of that used in the development of the FICO scores, the different scores that you have?
I'm just surprised it took us this long into the interview for you to mention AI, Rob.
I mean, I think you guys have used traditional AI for a long time, and I use the air quotes around that because I'm old enough to know and have a patent in one of those, like, for quite a while now, and it's not all Gen AI, but help us understand how that's used. AI really contributes to that, to the scores.
How we use AI in the FICO score development, I would say very carefully, and the reason that's my answer, I've gone on record saying this before, I think the FICO score is the most scrutinized predictive analytic in the world. We already talked about how millions of consumers are monitoring their score every month, seeing how their behaviors translate to changes in the score. We know the lenders are certainly scrutinizing the score. They're using it in billions of lending decisions every year. So the importance of transparent model, the importance of explainable model is at the very top of our priorities when we build the FICO score. And what we found is that some of these state-of-the-art AI, I think when a lot of people talk about AI, they're thinking about neural nets, they're thinking about stochastic gradient boosting, those sort of techniques. We found that we're still not quite there as far as cracking open the black box to the extent that we feel it delivers on that transparency that's necessary for the FICO score. So the way we use AI is as a really helpful, fast, powerful assistant, let's say, providing benchmarks to us of what's the ceiling of predictive lift and how close to that ceiling are we able to get, and the answer is very close, with some of our very complex but very transparent and explainable techniques that we use to build the FICO score.
Yeah, I think to me that was, I think explainability and responsible AI has been definitely a theme that I've heard here at FICO World this week, and I would say that makes a lot of sense given what you're dealing with and how emotional people can get about things like their FICO score and FICO scores for that matter.
Yeah, and again, there are great strides being made in explainable AI. the standard is so very high for the FICO score
Right.
in particular
I
for
mean,
explainability.
At the end of the day, right, lenders trust the FICO score. They trust that it's going to be robust over time, that it's going to be consistent over time. So we take the responsibility of that very seriously because we know what it impacts in the ecosystem. And so, it's something that Ethan and his team do an amazing job of managing and making sure that we can continue to be that standard of trust in the industry.
Yeah, I've even heard blockchain used about being able to stamp the models and things of that nature and understand the lineage and all of that, which to me goes back to, hey, how do I go to a lender and be able to say to them, hey, you know that this is where it is and here's the different revisions and things of that nature and really making them mutable.
But to your example, a powerful assistant.
Correct.
Never in the driver's seat. I think that's a key philosophy we have with our scores is there will always be a human, not only in the loop, but with their hands firmly on the steering wheel.
Yeah, no, I think that's a great segue into, Julie, let me ask you, FICO score team seems to be always innovating. I think, again, you're giving me the feeling that you're trying these things and making sure, which I love, that hey, when it's ready, kind of when it's fully baked. What are some of the things that you see coming on the horizon for FICO scores?
So I think Ethan talked a little bit about Ultra FICO, and that's using consumer permission, DDA data, to actually provide a different lens of borrower credit readiness, and so we're excited about that. We have new developments coming out associated with Ultra FICO, but we recently published a study associated with buy now, pay later loans, so BNPL data with a partner Affirm, which is a very large BNPL lender, and we were really excited about the results of the study, and so with that result of the study, we also announced that we will have a product announcement coming very soon. I can't give you the scoop on it today, but it is coming very soon, and we'll be making and adding a proprietary treatment to FICO models to address buy now, pay later information that will be furnished through the credit bureaus. Why this is important is we've seen incredible growth of utilization of buy now, pay later as a lending vehicle. We see consumers using it. We know that we need to be able to understand and use that data appropriately in the assessment of the FICO score. And this study allowed us to take over a year to take a significant volume of data from our partner Affirm and really assess the impact of buy now, pay later information when furnished to the credit bureaus on the FICO score. And Ethan and his team, took the challenge of basically analyzing that data and then understanding how that should be incorporated into the FICO score. So I'll let Ethan tell us a little bit more about the stats and the details on that because he's more appropriate to do that. But we're excited about the coming soon product announcement.
Yeah, thanks, Julie. I mean, what I'd say first and foremost, what we realized was simply feeding this new type of data into the existing algorithms, which were calibrated on traditional credit products, is not the answer, right? So there is, as Julie said, a nuanced treatment that's required if you're going to feed this data in. And at the same time, again, through our innovation, through our creativity, we found a way where we can capture some of the signal that exists in this BNPL data, avoid lenders having a blind spot around the fact that consumer has this type of debt without having it inappropriately and adversely impact consumers' scores. So we found, especially for those consumers who are opening 5 or more BNPL, which is not uncommon, whereas it's unheard of for a traditional credit product to open 5 new personal loans in a month. We found that actually the majority of them with this enhanced treatment either had no score change at all or had a positive score increase as a result of their positive behaviors on those BNPL loans.
Well, that's awesome, and I think that'll be something people will love to hear, and I think that's a great place to end this because I think, again, understanding that can be a positive note to folks that are out there using those, and that they, again, you're helping illuminate that so they get credit, the good credit for that as well. So, thank you both for coming on board, and this has been, no wonder you've been getting stopped. I mean, it's not shocking to me the FICO scores are all, what everybody knows, so I'm not shocked that you are the 2 rock stars walking around here this week.
I'll take it.
Yeah. Well, thank you for coming on board.
Thank you.
Thank you, Rob.
And thank you for watching this episode of FICO World 2025. We're here in Florida and we'll be back shortly. Stay tuned.